Hi, everybody. This is Matthew Burke. I'm a partner with the accounting firm Cerini Associates, here to talk to you about an accounting update, to go over some new accounting standards updates that have been brought down by the FASB and other regulatory bodies. So we do have a lot to cover today. As I said, I'm a partner here. There's my phone number. There's my email. Send me anything that you may need answered after this presentation. Be happy to do that. I want to get right into it because it is a pretty packed agenda. There's a lot of content here to go over. The first, I'd like to start with a little bit of the evolution of these accounting standards, why they change, how they change, who the FASB is, and why should we care. So the FASB is the Financial Accounting Standards Board. In short, they're the ones who create the accounting regulations that we all have to follow. Now, we all are nonprofit practitioners, for-profit companies, everyone's subject to this FASB and the rules that they put down. So they were established in 1973. They're an independent private sector. They themselves are a nonprofit organization based out of Connecticut. And like I said, they established the accounting and reporting regulations for public and private companies and not-for-profit organizations that follow GAAP. So there's a lot of acronyms that are going to be strewn about this presentation, and US GAAP is one of them. Generally accepted accounting principles, that's generally the basis of your financial statements that are issued to lenders, to donors, to whoever that is a stakeholder in your organization. So the 7 members of the FASB board, they serve full time and they have to be independent. So they're severing their own connections with the firms or other institutions that they used to work with before joining this FASB board. They have diverse backgrounds. They have a concern for investors, other users, and the public interest in matters of accounting and financial reporting. They have knowledge of all of this stuff. And they're the ones who are judging and basing their decisions on, what's best for the community as a whole and all these different stakeholders. Nonprofit is not something that they focus a ton of their attention on. A lot of it is based on, SEC, publicly traded standards and things like that, other private companies. But you will see that some are very specific to nonprofits, some of these accounting standards. Others, there's standards that don't really apply to nonprofits, and then they later implement them and make them connect to nonprofits. It's a bit of a mishmash. So like I said, in short, they're the ones who create the accounting rules that we all have to follow. How do these changes happen, though? So the first step is the board identifies financial reporting issues based on requests and recommendations. And you can go to the FASB website, you can submit inquiries to them, you can submit feedback to them. They have a technical agenda, which you can see. I looked at it this morning to see it's really what are the hot issues that they're dealing with, that they're trying to potentially make accounting regulations changes for, or that they're just researching to see if things are the way they should be now already. So once they have a technical agenda item together, they deliberate, they have public meetings if needed to identify these issues. They issue what's called exposure drafts to solicit broad stakeholder input. So these exposure drafts go out. It's basically fact-finding missions, trying to ask for information and feedback from stakeholders, which would be people like us, users of financial statements or auditors or accountants, CPAs, and things like that. Sometimes they may issue a discussion paper to obtain even more input in the early stages of a project. Sometimes they hold public roundtable meetings on exposure drafts if they're especially controversial or popular and have a lot of people interested in what's going on there. They analyze the comments, these public roundtable discussions, all other information that they get through these due processes, and they deliberate and they come up with proposed provisions. They try to consider stakeholder input received at these meetings, and ultimately it results in an issuance of an accounting standards update. Here's another acronym, ASU, that describes amendments to the accounting standards codification. So the codification is basically the library of all accounting rules and regulations that we have to follow. And these ASUs are what updates that ASC, that changes them, that clarifies them, that nulls and voids certain aspects of them. There's another regulatory body that's involved that we'll be talking about today that we should care about. That's the AICPA, another acronym, American Institute of Certified Public Accountants. It's the National Professional Organization of CPAs. So I belong to the AICPA, my firm does. Really any CPA who's practicing belongs to the AICPA. It sets the ethical standards for the profession and the US government, the general auditing standards, so that's GAS, not to be confused with GAAP, for audits of private companies, nonprofit organizations, really everybody. So I, as a CPA, as an auditor running an accounting firm, I have to follow the AICPA rules and regulations for how I conduct my audits in my business. The AICPA used to run the accounting rules until the FASB was established in 1973. So that's something that not many people know about. And the Auditing Standards Board, the ASB, is the AICPA Senior Committee they are in charge of the auditing, attestation, and quality control applicable to the issuance of audits and attestation, which is a type of audit in a sense, reports. It serves the public interest. It develops, updates, and communicates these standards and guidance to practitioners like myself to ensure that we are providing high quality, objective auditing and attestation services. So an audit really should be consistent regardless of who's performing that audit, and there should be certain quality benchmarks and checks that have to be met for every audit, and that's where the AICPA steps in. At the end of this presentation, we're going to talk about some of the changes to the standard auditor's opinion that came out from the AICPA. It's the only reason why we're bringing this up. So the standards issued by this AICPA are called Statements on Auditing Standards. We call them SASs for short. So in short, to summarize here, the AICPA, they create and modify the rules that we as CPAs must follow in performing and reporting on audits of your organization. So that impacts you because it affects how we audit you. Here's a list of the accounting changes that we plan on going over here. Like I said, it's a packed agenda. There's a lot here to go over. Some of these are more intense than others. So the first one is the PPP loan program, which we'll talk about. It's very timely. It affects all of you, well, most of you probably, and it affects you now. The revenue from contracts with customers, that's something called ASC 606. That's the new revenue recognition rules that affects you now. Also, we'll spend a lot of time on that. Clarifying the scope and accounting guidance for contributions received goes along with the revenue recognition rules. We'll talk a lot about that too. Leases is coming up next. That's the next big accounting standards update that affects really everybody in the world. Public companies already have to deal with it. Private companies do not yet, but they will soon. So you want to get that on the radar. Then the following ones after that are pretty small. Some of them don't really have much of an impact on nonprofits. We'll gloss over them. Some have a little more. And then, like I said, we'll end with those SASs, the changes to the standard audit reports and how that may affect you and your organization in the audit reports that you ultimately get from us and other CPA firms. The first one, the accounting for Paycheck Protection Program loans, is very important. Obviously, you know, because of COVID, the CARES Act came out pretty early on, and there was a lot of relief, targeted relief that came to all sorts of organizations and entities. It's not just a nonprofit or for-profit thing. Really, everybody needed these funds and got them. So the PPP loans were meant to pay for payroll and related expenses, some other expenses too, but principally payroll. And it had a forgivability component, which was what was enticing to everybody. You know, if you spend the money in accordance with the loan provisions, the entire loan would be and should be forgiven. So because of that, it created a bit of a question as to how to account for these forgiveness or forgivable loans. And really what the FASB and the AICPA jointly came up with in what they call a technical Q&A. So this was not an ASU. It wasn't as formal a process as it normally takes to get to this point because, you know, it happened in June of 2020 and COVID just hit in March. So it was something that happened very quickly. So they kind of pushed the standard framework aside to come up with a quick relief, quick answers here. And really to boil it all down, you have two options for classifying and accounting for these PPP loans. The first one, you can classify it as debt, and that would follow ASC 470, the debt rules for accounting. In that, you recognize the PPP loan payment in full as a debt liability. You accrue the interest according to the loan's contractual terms. And then when forgiveness income is recognized and the debt liability extinguished, that takes place when the SBA formally approves the forgiveness application. So the PPP loans would go through first your lender, who would approve its application for forgiveness, and then that would go to the SBA, who has some time to approve or deny that. So once the SBA approves that forgiveness, that debt would come off the books, and then you would record that income. So obviously that's a bit of a delayed recognition of income compared to when the cash comes into your organization. Any amount that is not forgiven would continue to be accounted for as debt and repaid pursuant to the terms of the loans, or if you prepaid it, it would come off the books then. So option one, record it as a liability until it's forgiven by the SBA, at which point you record the revenue and the extinguishment of that liability. The other possible method for recording the income or the loan itself is as what you would analogize to a refundable government grant, a conditional grant. So you recognize the PPP loan payment as a liability, not necessarily a debt per se that's going to be repaid, but a liability, and you recognize forgiveness income and reduce that liability when the conditions of the loan forgiveness are met. So we all know what those conditions are. It's that you spend the money on qualifying expenditures in a certain period of time. So what you would do is record the revenue pretty much when the expenses that underlie the forgiveness application are incurred. So this would result in an acceleration of the revenue recognition as opposed to the first method, which would defer recognition of the income until the SBA approved your forgiveness. So you may have spent the funds in, let's say, April, May, June, but you haven't even gotten forgiveness yet. So if you spent the funds in April, May, June of 2020, under method 2, you record the income in 2020 in those months, as opposed to in method 1, you would record the income when the SBA ultimately approves the forgiveness, which in my example hasn't really happened yet. We're seeing in practice probably a pretty even split here. Some organizations are looking at what their net bottom line was and how COVID really affected their bottom line. If they had a very bad year, they may look to record the income using method 2, as a grant and sort of offset the expenses with that revenue. If they had an okay year despite COVID, if they're still in a good financial position, they seem to be electing to carry it as a debt until it's forgiven by the SBA. Obviously, there's another consideration here in that there's PPP loan 2, the second phase of the PPP program, which came out pretty recently. The same rules apply to that, and that obviously is a consideration too for organizations when they're deciding how to record the income on this, whether it's accelerated or deferred based on these points here. On the subject of revenue recognition, this is a big one. This one really affects everybody now. So if you look at the implementation dates for this, per ASU 2020-05, this happened during COVID. The implementation of revenue recognition and leases really and some other ASUs was deferred by a year. So if you haven't implemented the revenue recognition's new rules in the 2019 calendar year, 2020 fiscal year end, you have the option to push it off until calendar 2020, which is really now, or fiscal 2021. Most fiscal organizations are June 30 year end or August or something like that. That would happen now too. So this is very timely. We're going to spend a lot of time here because it's important. It gets complicated, and really you should be dealing with this now. If you're not, you should be. Make sure you are looking at all the different aspects of these ASUs that affect your organization. So the whole point of this is the FASB wanted to create a single principle-based standard that can be applied across many industries. Before this ASU and this new revenue recognition model, there were different ways to recognize revenue based on your different industry, and it was a bit all over the place. So this was their attempt to unify the rules around revenue recognition into one or two major conceptual frameworks that can be applied to for-profit organizations of all types and nonprofit organizations too. It's supposed to be applied retrospectively, meaning going back in time and restating prior financial statements. Thankfully, what we're seeing in practice is that it's not having a tremendous impact on nonprofits. So the word restatement, is dirty. You have to go back and change prior numbers and things like that, as if there were errors in the past, even though it's just adopting new accounting principles. But like I said, in practice, we're not seeing a whole lot of that really required. Just a lot more documentation and disclosure in the financial statements more than anything. But what is this? What is this major change to revenue recognition? Really, what you have to know is that it's only applicable for exchange transactions. So exchange and reciprocation, those are the key words here. So in this case, exchange is meaning, both parties get something. So if you have a revenue arrangement, usually a contract or something like that, where you're getting paid for services that you're providing to somebody who's gaining the benefit of those services on the other end, it would fall under these revenue recognition rules. If you don't have that reciprocation, if you don't have that exchange where both parties are getting value, you're in a contribution type situation, which we'll cover in future pages. So, the overarching themes for nonprofit revenue recognition are these: contracts with customers, ASU 2014-09, and then contributions, which we'll get to ASU 2018-08. So really what this does, we'll skip forward here. It creates contracts with customers that you have to really go through and make sure that you are understanding all the terms and following a 5-step program for recording your revenue. So it affects all contracts with customers. And don't get hung up on the word customers here. It's a for-profit word, but for you, it can be consumers, it can be whoever's funding you, it can be beneficiaries of your services, it can be attendees of events and things like that. It doesn't include these different situations. So lease contracts, if you're a lessor of property, it doesn't apply here. If you have insurance contracts, it doesn't apply here. Investment income on investments that you hold, interest and unrealized gains and things like that doesn't apply here. and some others which really don't come into play too often. And then most importantly for nonprofits, it does not include contributions. There's different revenue recognition rules for contributions that are outside the scope of this contracts with customers ASU. I know it gets muddy, but it'll start to make more sense as we get through this. The areas where this ASU and these ASUs really impact nonprofits are here. Memberships. So organizations may provide memberships, which is obviously a benefit to the members in exchange for dollars received by the organization. Subscriptions to newsletters, periodicals, things like that. Actual products and services, obviously both sides are getting something out of that. Royalty agreement's the same. Sponsorships at events, this is one that's really coming into play practically. Most organizations have events and they get sponsors for that. In the past, you may have recorded that just as a straight contribution. But here, you might look at more closely at that contract and say, well, the sponsors are getting some sort of tangible benefit for sponsoring, whether it's recognition or advertising or something like that, that comes into play with this ASU here for revenue recognition. Conferences and seminars, obviously, tuition and other fees, obviously the students are getting the benefit of the tuition and the education there, advertising, licensing, and then some federal and state contracts, they don't all apply here. That's where it gets the trickiest, is the state and federal and local contracts. They're all a little bit different. Some are budget-based, some are reimbursement-based, some are fee-for-service, some are a mishmash of the two. What I want to say and disclaim is that there's no easy solution for those. They really need to be looked at closely and on a fact-by-fact, case-by-case basis, determine if this revenue recognition model applies or if the contribution recognition model applies to those contracts. So here's what it boils down to. It's a 5-step process for ultimately recognizing revenue pursuant to these new rules. The core principle here is that revenue should be recognized in the amount that consideration an organization is entitled to for the transfer of goods and services to customers. Then again, you see the exchange language. So you're getting something and the other side is getting something too. And here's the 5 steps. 1, identify the contract with the customer or consumer, whoever. Identify the performance obligations within that contract, determine a price, allocate that price to those performance obligations, and then recognize the revenue when or as those obligations are satisfied. This is going to apply for every contract for customer. You have to look at it through this 5-step lens. So we'll walk through each step to make it a little bit easier to understand. The first step, you have to identify the contract. So certain criteria that have to be in place in order for a contract, in written terms, becomes an actual contract in accounting terms. So the accountants like to mix up the English language with their own specific definitions of words, and contract is one of those situations here. But in order for it to be considered a contract for the revenue recognition purposes, it has to be approved by both parties. Obviously, both parties have to be committed to it. The rights regarding goods and services have to be identified. The payment terms have to be identified. Has to have commercial substance, obviously be a valid legal document. And collectability of consideration is probable. That's an important one. An open-ended contract that doesn't necessarily have the dollar amount on there, or if it's an extreme situation where the dollar amount is not likely to be collected due to the contract not being able to be fulfilled, or the other side of the contract not necessarily having the financial wherewithal to fulfill that contract, it wouldn't necessarily stand as a contract in the eyes of the FASB here. You can combine contracts when they're with the same customer or consumer, if they're as part of a package, or the consideration in one contract is dependent on another, or if it's really one single performance obligation broken up into multiple contracts. So again, a lot of this gets really muddy, but the important point to note, step 1, make sure you actually have a contract in place before you're subjecting that contract to these revenue recognition rules that are a bit different than they used to be. This might be the most important part. Step 2, identify the performance obligations. So we have a contract now. Now within that contract, we have to see what the performance obligations are on both sides. So in the case of a good or service type contract, it should list out, these are the goods or services that are being provided. Sometimes and oftentimes really there's a series of goods or services that are substantially the same. They have the same pattern of transfer to the customer. So it's best to explain through some examples here. Some performance obligations that you may have or may run into. Housing-based nonprofits might enter into contracts to build a home. So what's the performance obligation there? I will get paid by the home buyer, me being the nonprofit, if I build them a home and transfer that home to them. So the obligation is to build that home and transfer that to them. Again, you can see the exchange side. Homeowner is buying, giving dollars or mortgage to the nonprofit, and the home buyer is getting something to live in, a home. An animal rescue nonprofit, we've seen this, has a royalty agreement that will allow a commercial company that manufactures dog treats to say that they're approved by the nonprofit. Again, two sides there. Performance obligation is that loyalty agreement allowing the commercial company to manufacture the dog treats with that stamp of approval. Here's an easy one, tuition. A school charges parents $1,000 a month to enroll their children in a daycare program. So the performance obligation of the school there is to have these children in the daycare program and provide those daily services to them while they're sitting there. And on the other side, the parents are giving $1,000 a month to the school in exchange. Naming rights is something that we see. There's others, events, performance obligations. If you're selling tickets for an event, the obligation there is to hold the event and allow those attendees to come to the event and get the benefit of being at that event. So that's the performance obligation there. Government contracts, again, some of them may fall into here, some of them may not. Again, that's a case-by-case basis that you should look at very closely. Next, once you have those performance obligations set up, you have to determine the transaction price. So what are the customary business practices used to determine prices? Hopefully and usually the prices are outlined in the contract, but oftentimes they're not, or they're bundled together. So really the transaction price, it's strict definitions, the amount of consideration an entity expects to receive in exchange for transferring those goods or services, excluding amounts collected on behalf of third parties. So for example, we said a membership organization earlier. So membership organization has part of its annual dues. Part of those dues may be for a related organization, political action committee or something like that. That would get pulled out. That's not part of the price. That goes somewhere else. So examples of the actual transaction prices, they may be fixed amounts, tickets to a golf outing, it's pretty set in stone, for a foursome at an outing costs, let's say $1,000. There's your price. Variable amounts could be discounts at stores. Both a cemetery plot. We have some cemetery clients who they build in, the price of the plot for burial and then related perpetual care for that plot over time. And sometimes it's just one price, and then you have to try to pull them out into each individual component. So what's happening with this revenue recognition rule or rules is that people are looking at their contracts a little bit more closely now and trying to write them in such a way that it makes it easier for the accountants and the finance people to determine the transaction prices and to assign those prices to performance obligations, which is the next step. Now you have prices, you have to, like I said, assign them to each performance obligation. You have to use some sort of systematic method or manner that's consistent, that makes sense, that's reasonable. The standalone selling price is the most common method. So in the examples earlier, if a cemetery plot costs $3,000, that's your price that you'd allocate to that performance obligation. And maybe if you're charging $5,000 for the plot plus the care, then the $2,000 gets assigned to the care just automatically there. But there's not always selling prices that are a standalone basis that are built into these contracts. So then you have to estimate. You really have to do your best based on these different methods here. Adjusted market assessment. So it's really just an estimate. What would the market pay for these different bundled services? If I'm charging 5 things in one, you try to pull out each of those 5 different performance obligations and assume and estimate how much each one individually would go for. Another method is the cost plus margin. So if you can calculate how much that cost would be, and then assume a fair and reasonable markup on top of that, that could be a way to price out certain performance obligation. And then the residual value method, like I said, allocate the value first to whatever has a standalone selling price, and then the rest can go to the other components and the other performance obligations that are in place. And then step 5, you recognize the revenue when the performance obligations are satisfied. So think of what we did up until this point. 1, we confirm that we have a contract. 2, we determine what the performance obligations are. 3 and 4, we assign values to those performance obligations. Why? Because as you're fulfilling those obligations, you then recognize those values as revenue. And that's where it all really comes full circle, and it all connects, the dots connect in the end. So revenue is recognized when those are satisfied. When it's satisfied is really generally defined as when an asset or a service is transferred. So an asset is transferred when a customer or consumer who obtains control of that asset. Service, same thing. When they get the benefit and receive the benefit of the service that you're providing and charging for, the performance obligation is considered to be met. Control is important. So control of an asset gives the acquirer of the asset the ability to direct the use of and obtain all the remaining benefits from that asset. That also provides the ability to prevent other entities from directing the use of and obtaining the benefits from that asset. So control is important. It's probably usually pretty obvious, but there may be situations where you have to determine whether or not control of an asset has truly transferred over, or if services have truly been transferred over to the end recipient. There's different ways to recognize the performance obligations when they're met. It's either satisfied over time or at certain points in time. And this, of course, gets a little bit complicated too. Sometimes you may have a customer simultaneously receiving and consuming the benefits, like 20 tickets to a museum. Each time a ticket is used, it's pretty obvious that, those points in time, the performance obligation has been met. The entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. That's another one. So if you're adding an enhancement to a client's website, that would be a performance obligation that's met that would trigger recognition of revenue based on the value ascribed to that performance obligation. The asset created has no alternative use to the reporting entity, and the entity has a right to payment for the performance completed to date. So this is very rare, probably doesn't come into play for any of you, but if midway through a contract, the contract is terminated, but the contract provided that the customer is responsible for the expenditures incurred to date, you would then consider that revenue earned when the contract is terminated, right? The performance obligation there is met because no one else can get any benefit from whatever was going on in that contract. Best way to illustrate these is always through examples, though. So we have here a nonprofit membership organization. It's very simplified. Let's assume they have annual dues for their members of $200. And the only thing that the membership organization can ascribe value to as part of that $200 contract now is a monthly newsletter. Otherwise, it's just, they can come and go to the membership organization. They take part in events and things like that. But the only thing with real tangible value that they can point to is the $48 monthly newsletter. So how would we account for this? Go through the 5-step program. 1, identify the contract. So the contract is the $200 membership due, but within there, the newsletter. The newsletter has to be given to the customer, the member. It's an exchange transaction. It's valued at $48, but that's what they get in exchange for the dues that they're paying. What's the performance obligation then? So it's the provision of that monthly newsletter. If you don't do that, then in a sense, the membership organization is not fulfilling its end of the bargain, its contract obligations, and it's, really operating in bad faith. Determine the transaction price. It's determined that there's a fair value of $48 for that monthly newsletter. So again, go back to what we said earlier. How is that determined? It might not be spelled out in a membership agreement. It's probably not. So in this case, you would say, okay, as the membership organization, how much would I charge for this this newsletter? $4 a month, $48. So that $48 is allocated to the performance obligations to provide the monthly newsletter. The transaction price, what is it? Again, it's kind of repetitive, the $48 here. So how do we recognize the revenue then? The $48 is recognized as revenue over the course of the 12 months because it's an annual due. As each issue is provided to the member, $4 is recognized. 48 divided by 12. Previous GAAP would have had the $200 recognized over the 12 months. So this is where it gets a little bit different. The remaining $152 here is a contribution, since there were no other specific identifiable benefits provided. So prior to this revenue recognition rule, you would take the $200 of annual dues and ratably recognize them over the course of the 12-month, the duration of the dues period. Here, you don't do that. Here you say the only part of the $200 of dues that has any real tangible value is the monthly newsletter. Record that monthly newsletter over the life of the dues. The rest is really just a contribution hidden within the contract. So this is something that we're seeing it affect chambers of commerce, social clubs, things like that, organizations like that, C6s, C7s, more so than 501c3s. There are some C3s that have membership models too, though, and this certainly affects them. And if this is you, you should really take a close look at your contracts. You have to go through and value what members get as part of their membership contract. You have to then ascribe those values to those different performance obligations, and you may have a contribution component hidden and buried within your annual dues. Realistically, what we're seeing a lot of organizations do is kind of estimate all the different components of these memberships, parse them out, and ascribe value to each of them to match the full value of the annual dues. Here's the simplistic example. We didn't do that, really just to prove and illustrate that this gets a little complicated. So you might have contributions where you didn't realize you had contributions before. Another example, tuition and fees. This one may be a little bit easier to understand. Nonprofit college or any really education institution, there's a lot of different fees that come into play with these types of arrangements and contracts. So after the new student orientation, the student registered for classes and received the tuition statement for $10,000 for the semester. College charges an additional $200 in fees, which is normal. And then of course you have books for an additional $300. So a total of $10,500. Students can withdraw with no charge within the first 2 weeks of the semester. So how would we go about attacking this contract and making sure that it's accounted for correctly? First, the student, you have to identify the contract. So the contract exists for the tuition and fees after the withdrawal period ends. It's cancelable until that point in time. So there's no contract-related books until they're ordered or purchased. What are the performance obligations? So the obligations are to provide classes to the student services, and access to the textbook provider. What's the price? The tuition and fees is $10,200. You know, the tuition plus the 200 in fees, and the textbooks is pretty clear. It costs $300. Allocating the transaction price, pretty simple too. Spelled out: 10,000 to the classes, 200 to the student services, and 300 to textbooks. So when do you recognize the revenue though? You would pick up the $10,200 for the fees and tuition ratably over the semester once the withdrawal period ends. So over the course of time as services are provided, and the $300 are recognized at that point in time when they're purchased. So again, you can see for a, let's say a $10,500 contract, there's different components here that can be picked up and recorded at different points in time. So now the other side of the revenue recognition model are contributions. So everything we just talked about were these exchange transactions. Contributions are non-exchange. It's when you're really getting a donation and the donor is not getting any value in exchange. So these amendments clarify and improve the scope and accounting guidance around contributions of cash and other assets received. These are effective now. So this followed the same timeline as the prior slides. Was a 2019 and 2020 fiscal year end implementation date, delayed 1 year because of COVID. So now 12/31/20s and June 30, 2021s have to implement this. So really the whole point of this is when do contributions get recorded and how are they classified? So it provides a more robust framework for determining whether a contribution is conditional or unconditional. That determines when the revenue is recorded, and for distinguishing a donor-imposed condition from a donor-imposed restriction. So conditions and restrictions are different. Conditions prevent you from recording revenue. Restrictions, they're already revenue, but they're labeled as restricted or not restricted. It gets very complicated, and frankly, the terminology is all too familiar and too similar to one another, so it gets confusing. So the key differences between the contribution rules and the revenue recognition rules, the contracts with customers: commensurate value has to be in place. So exchange transactions qualify under the revenue recognition rules, take place when both parties receive that value. Non-exchange transactions qualify here under the contribution rules. Conditions versus restrictions. So conditional contributions involve barriers, that's the key word, to be overcome, and a right of return to the resource provider. So if there's barriers on the language and verbiage within a donation that have to be overcome before you really earn that donation, you haven't really earned the donation yet. Once those barriers are overcome, that's when you record that as revenue. Restrictions are less specific. They don't result in returns of funds or penalties or anything like that. They just specify how those funds should be used at a certain date and time or in specific programs and things like that. So again, you can see how this gets complicated and confusing and frankly annoying. So if you have situations like this where you have complicated language in your donations, you should look at it a little bit more closely and compare it to the language in the FASBs to see if it's a contribution first or if it's revenue recognition rules. And then, are there barriers to overcome? Is it conditional or is it restricted? With all of this, including the revenue recognition rules and the contributions, there's disclosures of the policies that have to be made in the financial statements. The conditions or restrictions should be spelled out pretty clearly if they're significant as well, all in the footnotes to the financial statements. So to summarize, this is all revenue recognition here. We're moving on to leases after this. The key terms: the 5-step plan for contracts with customers is important. After that, you want to make sure that you're recording conditional and restricted contributions correctly. So you have to really have a good understanding what those conditions are versus restrictions. That's where we're seeing our clients get tripped up more than anything is, when to apply the contribution or ASC 606 revenue recognition guidance. And once you determine that, how to implement both. And what I like to say to all of our clients is if you have complicated situations come up, you should ask us. We can help walk you through that. The next major area of new GAAP is these new lease standards. So this has been a long time coming, since really 2016. It's still not in effect. So thankfully, non-public entities, including nonprofits, may delay implementation of this until the calendar 2022 year end or 2023 fiscal year. So we have some time here, but really get this on your radar because it gets a little complicated. Early adoption is permitted. We're not seeing anyone really early adopt this because frankly, it's a big burden and administrative cross to bear to get through this. You would have to issue comparative statements that are restated using a modified retrospective transition method, which we'll talk about. And then you can see a lease in defining the contract of a lease here, that the terms, it has to explicitly or implicitly specify the use of an identifiable asset, and the customer, the lessee, has to control the use of that asset for a period of time. Still have a distinction between capital and operating leases. It just won't have the same effect that it has had on the financial statements as it has in the past. So the easy example here is leasing space. It's always been an operating lease. You record that as an expense over time. When the lease is up, you either renew or you move on or something else. But it's always an expense. It doesn't hit your balance sheet. The new rules will require that long-term leases like that be thrown on your balance sheet as assets and related liabilities to be depreciated over time and to have interest accreted over time and expensed that way. So it's a bit different. So the approach, I don't want to spend too much time here. This is how to initially get the leases on your books. And I want to spend most of the time on the practical expedients. So leases that are in place at the time that this lease standard becomes effective, they don't necessarily have to be restated. You can elect this practical expedient, which is these three here, that you don't have to really look back in time. You can just deal with new leases going forward that may have to get hung up on your balance sheet. That's helpful, and it'll save you some time there. Really, what will happen is all leases, including operating leases with a term of greater than 12 months, so if it's less than 12 months, you don't have to worry about this either. They'll go on the statement of financial position, your balance sheet, with what's called a right of use asset and a corresponding lease liability. The problem here is it could affect measures. It could affect debt service coverage ratios. It could affect your conversations with banks about what gets qualified and what goes in there and things like that. So really, you have to determine that at lease commencement if it's either a finance lease or an operating lease, just like you have in the past. And that'll affect how you actually record this. I don't want to spend a ton of time here because it's a little bit granular, but just know that there's ways to calculate the lease liability. It's a present value calculation. The problem here is that leases don't usually disclose an interest rate that's implicit to the lease. That's something that'll have to be pulled out of the lessor and the finance company over time to make sure that you can calculate this lease liability. The asset is usually a function of the lease liability, and you can build it from there. So initially, you would record that lease liability and related asset, and then over time, you're going to depreciate the lease asset, and you're going to amortize the debt portion, the finance portion of the lease liability based on that effective interest rate and all that other stuff. So we'll make these slides available, and obviously, if you have questions about this when you're in practice trying to implement this, please let us know. We're happy to help there. The other important point is non-lease components. So if you have variable costs or maintenance or things like that, they do not get carried into that lease asset. They just get expensed as they always have. Short-term leases, like I said, they're not subject to this. And then obviously more disclosures will be in your financial statements to describe your leasing arrangements, how you're accounting for all this, if you're using the practical expedients and so on. If you're a lessor, the good news is that the new lease standards don't really have a major impact on you. We expected that fewer leases will qualify as direct financing leases. Most will become sales type leases under the new rules, which is kind of how things are now. So not a big deal, and this probably doesn't apply to many of you anyway. So let's move on. Here's another one that's not effective yet, but it will be soon. A lot of organizations get donations in kind, right? Where they're getting donations of whether it's space or non-financial assets, things like that. Right now, those numbers are generally blended in with contributions and sometimes disclosed. What will happen after this ASU becomes effective is you'll have to add a line to your statement of activities that's showing how much the donations in kind are. You'll have to disclose in the footnotes all these different factors. What the type of donations in kind are, what your policies are, how you valued them, and so on. So it's just adding additional disclosures and transparency over this area that really has been lacking in the past. There's a few slides here on goodwill. Goodwill doesn't come into play very often with nonprofits. Sometimes it might if you're acquiring a for-profit business entity or something like that, or another nonprofit at below what its accumulated net assets are, or something like that. Really, the takeaway here is that it's making the goodwill impairment tests a bit easier. If you have to ever deal with that, you know that it's very complicated and annoying. They're simplifying that slightly, and they're giving you the ability to amortize goodwill over a 10-year period of time instead of looking to impair it. So that'll get the goodwill off the books ratably over 10 years instead of dealing with all the complicated rules that are in place now. This one is over the horizon. It's a 2023 calendar year end or 2024 fiscal year end implementation date. It's called CECL, C-E-C-L, the current expected credit losses. So in recording allowances for doubtful accounts and bad debts right now, you're kind of using what's called an incurred loss method, which is usually when you know that something has become a bad debt, you record that bad debt. What CECL will do is change that to be more of an historical calculation, an estimate based on what you've seen in the past, even if you have no incurred losses to date. So it would probably increase your bad debt expense to a certain extent. It'll require certain disclosures of your methods for calculating those estimates on bad debt losses and things like that. Like I said, it's many years away at this point, the 2023 calendar year end. It mostly will affect financing type nonprofits. We have some clients who provide low interest or low income housing, and they have loans and things like that. I can see this having a more major impact there, but for other organizations, it just will require you to tweak your bad debt analysis on an annual basis and account for things a little bit more differently. They've been multiple ASUs here, so I'm going back and forth on 34, 35, and now even page 36 and page 37. All of these really just kept punting the date forward that CECL had to be implemented. So thankfully, you don't have to worry about that for quite some time. Some other changes. If you have a defined benefit plan, which is like a pension plan that has required payments over time, there's some disclosure changes that are effective for the 2022 calendar year end, 2023 fiscal year end. You can see here it's removing certain disclosures and adding others. This is something that you usually get from actuaries anyway. So chances are your actuarial reports will change to reflect these changes, and you'll be able to just strip the language out of those actuary reports and put them into your financial statements to match. Not a big deal, but something that may affect a couple of you. And now what I want to conclude with these last few slides is SAS 134 to 140. What it's doing is, and this will affect your 2020 calendar year ends and 2022 fiscal year ends, your auditor's opinion will look slightly different. So the auditor's opinion will have different headings now. What's most important though, and the most significant possible change, is that it will allow auditors to engage with organizations to communicate and represent key audit matters in the auditor's report. Those charged with governance, usually boards of directors, decide whether or not the audit reports that they get will include these CAMs, as they're called, another lovely acronym, these key audit matters. They may include, but not limited to, higher risk assessment in certain areas, areas that required significant judgment, usually estimates, and significant events or transactions that are in the financial statements. So there'd be a separate section in the auditor's report that describes these CAMs and what they are and what they're all about. So it's really blending some of the required communications in other forms of communication to boards into the auditor's opinion. And that'll be in effect really a year from now. We'll be dealing with this. Let's see, anything else here? SAS 135. Again, this changes related parties and significant unusual transactions that have to be reported to the board. It creates new communication requirements and required communication letters to boards that outline significant transactions, difficult matters, uncorrected statements that may affect future financial statements and things like that. So it's just a slight change here. And then the last page on SAS 136, if you have retirement plans that are audited, those audit opinions will change too. So really, this creates more work for your auditors. It may create a little bit confusion for you when you're reviewing financial statements from year to year, because the language will be a bit different in your 2021 and 2022 audit reports, whether it's for your nonprofit or for a retirement plan that deals with your nonprofit. The key takeaway there is the CAMs, though, and your auditor should be talking to you about those CAMs and whether or not you want to include them in your auditor's report if you want them to perform any procedures that are specifically designed to pull out those CAMs and put them in your audit report. Okay, so I want to thank everybody for joining. Like I said, you have my email. If you have any questions, please send them to me. Be happy to answer at any point in time. If there's anything we can ever help you with, we at Cerini Associates, we focus almost exclusively on nonprofits and schools. It's probably about 3/4 of what we do. We specialize in this. There's a lot of information on our website, a lot we can help with. So if there's ever anything you need from us, please reach out. We're happy to help. Thanks for listening.